part two. Obviously, we talked a lot about market risk in part one. Um, we're going to talk a lot about IULs and the importance of structuring them right. So, Jay, with that, it's yours.
Okay, thanks, Brian, and thanks again for asking me to be on here. Um, so yeah, we talked about the market risk in the first part of this three-part series, and we made the case that the stock market is at historically high valuation. Okay, it's overvalued by material amounts, and that there's going to be a reckoning at some point. It's just a question of when, not if. And that reckoning is likely going to be in the 50 to 70% range. And we can provide that link if anybody missed that presentation. You can watch the recording of that. We also made the case that the traditional tools for protecting ourselves against catastrophic declines in the market, tools related to diversification, are flawed, and that diversification in theory versus diversification in practice can be a very big difference. And we can think we're diversified because we see that some of my money is here and some of my money is here and some of my money is here, and that the places that are not the stock market are not very highly correlated with the stock market. That's the definition of diversification. But the expectation, which is proven false over and over again, is that when the stock market collapses, that lack of diversification is going to hold up. So the other places where I have some of my money, they're not going to collapse with the stock market. And people have learned the hard way, whether it was the financial crisis, the tech bubble, or pretty much any crisis we've seen historically. The asset classes that we thought were uncorrelated, real estate being a really good example, they auto-correlate when that big correction happens. So what we're going to do today is drill down a little bit more on one of the two product solutions that solve for that. Okay, and that's an IUL. I'm going to share my screen here. So give me 1 second. This is again briefly my background. Spend a lot of time analyzing financial assets, risk assets, the stock market, recommending securities within that market, investing in early stage companies. So understanding risk reward and financial assets. That's my background. We want to be clear that we're not here giving advice, financial advice, investment advice, tax or legal advice. The purpose of this call is informational and educational. Okay, so please keep that in mind. So we talked about a couple of products that solve for the conundrum, if you will. I don't want to sit on the sideline while the market continues to be strong year after year, but I'm really afraid of that 60% drop. How do I solve for that? I'm going to make an important statement up front. In my 30-something years analyzing and writing reports, research reports on financial assets and financial asset classes, in my opinion, if one is eligible, if it's suitable, if it's appropriate, okay, if it's in your best interests, which relates to your resources, your health, where you are in your career, and what your objectives look like, an IUL structured properly is something everybody should have. I really believe that. It's that good a product if structured properly. We're going to talk about that here today. If it's not structured properly, and something like 97% of the IULs out there are not structured properly. If it's not structured properly, you've got what's probably a so-so life insurance policy. But in a worst case, you've got a product that you're probably wasting your money on. That's if an agent has set up your IUL for maximum life insurance protection. The way an IUL should be structured, in my opinion, is for minimum life insurance under the IRS guidelines. Minimum life insurance for the amount of money you put in at your age and your health profile. What's the lowest amount of life insurance we can get away with in this plan and still preserve our tax-free withdrawal benefits. That's the way we ensure as much of your money going in goes into the cash portion of your plan as we possibly can get away with. That's the key to the structure. Agents like me, we get paid on how much life insurance is in your plan. There's a very small trail paid on what's in your cash. It's irrelevant compared to the commission on the life insurance. So from an economic standpoint, an agent has the incentive to put more life insurance in your plan. And believe it or not, even as fiduciaries, agents are not required to at least explain to you that you could minimize the life insurance in order to maximize the cash and explain to you why you might want to do that. An agent isn't required to do that. So overwhelmingly, agents are not in the business of explaining how to minimize their own commission to you. And they'll show you an illustration that might look pretty good. And if you don't know enough to push back and say, hey, what if we did less life insurance? Could we? And get more of my money going to the cash? If you said that, that agent would have to agree and show it to you in a different way. So that's the headline, okay? I'm a huge believer in this. I have one myself. It's structured with minimum life insurance, maximum cash. That's what I show everybody that I talk to and encourage everybody that I talk to that that's the way to do it. So what do we like about it? What am I talking about? Why is this so special? Well, the cash in an IUL in many respects is better than a 401k. If you don't have a 401k because you're self-employed or your employer doesn't offer it, even if you do have one, but your employer doesn't do any matching, if your employer does matching, you should take full advantage of that. Let me make that really clear. But this can be an alternative to a retirement plan. Everything I just said about maximizing the cash and minimizing the life insurance, that's how you make this more of a retirement plan and a personal bank than a life insurance policy. So how does it work? Well, I can peg my cash growth to any number of indices. I typically pick the S&P 500. So I work with a whole bunch of carriers. I don't work for any of them. I work with a whole bunch. So I try to find the best fit for the client. One of the carriers I work with offers up to 12.75% in the S&P 500. On the anniversary of your plan every year, what did the S&P do? You'll get up to 12.75%. Okay, that's the cap. 100% tax-free. You can take money out of your IUL as a policy loan fully secured by the death benefit, meaning the insurance company already owes the death benefit to your family when you finally pass away. They already owe it to you. So giving you an advance on money they already owe you, when they're going to charge you a market rate of interest, they're totally fine with that. No questions asked. It's your money. We don't pay taxes on loans. That's why my gains in the stock market effectively are tax-free. So up to 12.75% tax-free. If the stock market goes down in any given year, this particular carrier will still give you 0.75% growth. That's your worst case, is 0.75% growth. Okay, again, up to 12.75 tax-free, minimum 0.75. Guaranteed against the losses, up to 12.75 tax-free. There's nothing in the financial services universe that I'm aware of that offers that kind of upside versus downside scenario, that sort of risk reward. Guaranteed against the stock market losses. Here's the next thing. When you pull money out as a policy loan, as I just explained, you're actually borrowing the money out of the cash of the insurance carrier. You're not touching your own cash in the plan. Okay, so you've got cash in your plan. You could take that cash out if you wanted to. That wouldn't be a policy loan. And that would be tax-free up until you reach the point where you had a profit in your plan. But if you take money out of your own cash, you're not going to keep getting up to 12.75% growth on the money that you took out. You'd have less cash in your plan, right? That makes sense. But if I borrow the money from the insurance carrier, I'm not touching my cash. I'm getting the same amount of money out of the plan, is if I had taken it out of my own cash, right? This is the money. That's all I know. It's the same amount of money. But in the second case, I borrowed it from the carrier and I took their cash. I don't have to pay it back until I die, and it will be deducted from the death benefit. That's a 100% secured loan. So depending on the carrier, they're going to charge me 4, 5, maybe 5.5%. You can't get that from a conventional bank today, even if you pledge your house as collateral. So they're going to charge you somewhere in that 4 to 5.5% annual interest, which will come out of your remaining cash. But because you didn't touch your own cash, you're still getting up to 12.75% growth from the stock market on the proceeds of your loan. You're still earning the compounded interest. Well, if I get up to 12.75 a year, minimum 0.75, what does that averaged out to historically? North of 8%. Now, it may not do that in the future, but that's what it's done. Well north of 8%, probably closer to 9% actually. So if that's my average year of returns, and they're only going to charge me, say, 5%, I'm netting 3.5% income on money that I just took out and spent on myself. That's called infinite banking. I keep earning income on money that I've spent on whatever it is I want to spend it on. Infinite banking. Let that sink in for a second. Again, this is why if I could have every dollar that I put into a plan like this going into the cash, when the cash does everything that I just talked about, that's what I'd do. But these are plans that were meant to sell life insurance. The carriers thought, hey, what if we had a cash component? This is decades ago. What if we had a life insurance plan that had a cash component that did all the things that this cash does? I'll bet you people would like that better and would sell more life insurance. They were correct. They also made the calculation that independent agents that help us sell this to individuals, by and large, are not going to run around telling their client, you should minimize the life insurance and minimize my commission in order to maximize your cash. They were right. Self-interested agents, economically self-interested agents, aren't doing that overwhelmingly. As I said, if it's not done that way, if it's not done with minimum life insurance and maximum cash, at best, you've got an average life insurance policy. At worst, you've got a plan you're wasting money on. So important to talk to somebody who explains this to you exactly as I've just explained it to you. Now, the cash in the IUL isn't expected to beat the stock market. It really is. It's not. Okay. The stock market's going to get 100% of the upside and 100% of the downside. And long term, I should do very well on that. That's why we put our retirement money in the stock market when we're young. But what I do expect from the cash in my IUL is very competitive performance with a lot less risk. Okay, I don't participate when the market drops over 50%, as it did in the wake of the tech bubble. NASDAQ dropped 75% in the wake of the tech bubble, or another 55, 60% in the wake of the financial crisis. I get none of that. I sleep well at night. Everybody's 401k was down by those percentages when those crises happened. The tech bubble took 16 years to get my money back, to get back to break even. The financial crisis took 7 years to get back to break even when you adjust for inflation. So my IUL, my cash in my IUL, I never lost a penny during those crises. So when I look at the cash in an IUL since 2000 and see that it actually outperformed a straight investment in the S&P 500, I wouldn't expect that long term, but that's the kind of performance you can get, especially if your entry point, your starting point, is when the stock market is at historically high values. But I told you this in the last presentation. If you could have avoided all the downside since 1900 to 2025, 125 years, 41 years the market went down. If you were just flat in those 41 years, you only needed to capture 34% of the growth that happened in the up years. I only needed 34% participation in the upward growth of the stock market if I had been able to avoid all the losses. Just 34% upside needed to match the stock market's performance, but not have any of the downside and any of the headaches. I only needed 34% of the upside. I can get 50% of the upside in a fixed equity indexed annuity, or I could get 12.75% tax-free of the S&P 500's performance. Is that going to amount to 34% of the stock market over time? Probably should. So again, if I can take losses off the table, I don't need 80, 90% of the stock market's upside to participate, match the market's performance, or even beat the market's performance. An investment in an IUL since 2000, the cash value in an IUL has outperformed a same dollar amount invested directly in the stock market. It's outperformed it. $675 in your IUL cash for a $100 investment in 2000 versus less than $500 for a $100 investment straight into the S&P 500. Now, really important, if I invest in actual stocks that are paying dividends, I get the dividends. If I just peg my growth to the S&P 500 index, I'm not actually invested in the stock market. That's how they're able to guarantee me against losses. Okay, so I don't get the dividends in my cash value in an IUL. That's a meaningful, significant advantage to a direct investment in the stock market, assuming you take those dividends and reinvest them. Well, if I do that to change our comparison since 2000, the IUL cash still beat the S&P 500. The dividend yield of the S&P 500 is 65% lower than its long-term average. It's like 1.25% right now. It's not that much. But you still beat the S&P 500, even if you reinvested your dividends, which nobody ever does anyway. That's incredible. This chart should tell you that an IUL is an investment. It's an allocation of your assets for all seasons. This is worthy of an allocation of your assets, especially if you're younger. What this is going to look like long term. You're going to feel really good about having done this if you started this when you were 30 years old, 30, 35 years down the road. It is an investment for all seasons. But if you know the stock market is way overvalued, as we know it is right now, boy, does this become an attractive asset on a risk-reward basis in that type of environment. It just becomes that much more compelling when I know the incremental returns from where we are today in the stock market are going to be below average relative to history. That's what happens if my entry point is at historic highs. I'm going to quickly hit you with a data point. The S&P 500 index increased 60 times since 1980. The underlying earnings of the S&P 500, the earnings, the cash flow, that's what drives the value of any asset. So the underlying earnings of that S&P 500 index in the same time frame since 1980 has increased 4 times. The earnings are up 4x. The index itself is up 60x. Does that suggest to you that there's some significant systemic risk in the stock market? It should. It should. 60, 70% downside. That's what I would tell you. And I'd be happy to talk to you one-on-one and tell you why I say that. You'll at least agree it's possible if we have that conversation. Really quickly, to review that, Buffett indicator. Well, what's the value of the stock market divided by the underlying economy? Right? The economy captures all of the cash flow potential of the asset itself. So Warren Buffett said, well, if I divide the stock market's value by the value of the economy, that ratio is a really potent measure of whether the stock market is expensive, cheap, or fairly valued. That long-term trend line has been roughly 50%. Currently, that trend line is north of 100%, but the ratio itself is near 220%. That means you need a 70% correction basically in the S&P 500 index just to get back to the normal trend line, the historical trend line on the Buffett indicator. 70% downside. Warren Buffett's a pretty good investor. That 70% downside is echoed by the Shiller ratio. Okay, the S&P 500 index divided by the long-term average earnings, full cycle earnings of the S&P 500. Okay, cyclically adjusted earnings of the S&P 500. Divide the index by the cyclically adjusted earnings, we get the Shiller ratio. He won a Nobel Prize, by the way. That ratio is over 40. It was higher during the tech bubble. It's the only time it's ever been higher. Again, 60% drop in the stock market from here. There it is. That's what happened. NASDAQ dropped 75%. What do you think is going to happen here, guys? It's going to keep going? You need a 70% drop in the S&P 500, give or take, to get back onto the long-term historical average, around 17 times. It was around 13 and a half times for 100 years prior to 1980. We're at 40 times. Why? That's another whole rabbit hole we're not going to head down. And again, big corrections have taken a generation or more to get back to where you were. These are some of the big corrections in history. The era that basically precipitated the drop. Here's the number of years necessary just to get back to where you were before the big correction when adjusted for inflation. 19 years to get back to where you were during the antitrust era, which was driving the market down steadily. The crash of 29, 30 years to get back to where you were. The inflation bubble of the late 1960s, 24 years to get back to where you were before that correction started. The tech bubble took 16 years to get back to where you were. And the financial crisis, despite the Federal Reserve printing money and lowering interest rates, so the effective rate on the US 10-year Treasury was negative. You basically had to pay the government for the right to own a government bond. That's how low the interest was. That rate on the 10-year US Treasury, by the way, is highly related to the stock market. So the stock market's been overvalued for quite a long time right now. But 10 years ago, when the stock market was still wildly overvalued, the US 10-year was yielding a negative number when you adjust it for inflation. So why is that related? Because a big correction in the stock market requires some place for the trillions of institutional money that would have to be coming out of the market to have a big correction. Where's it going to go? It normally will go into the treasury market. But if the treasury market has a negative yield, that's considered a safety net for the stock market. Anytime you've seen the US 10-year below 4%, you have not seen a 20% correction or more in the stock market historically. So if I'm below 4%, meaning the yields are lousy in the bond market, I don't want to be in the bond market. So what happens? Institutional money in the bond market starts migrating into the stock market where it shouldn't be. It doesn't belong. It's supposed to be in a risk-free asset. But money managers start talking themselves into it. They start moving more money into the stock market. What does that do? It pushes the stock market even higher, increasing the risk of the stock market. Okay, so unless that bond market meets some minimum level of protection, it's beating inflation, you've got a safety net for the stock market. You don't have that safety net anymore. The 10-year is north of 4%. If you're a retiree and you look at these numbers and you look at the valuation of the stock market and you're not considering putting some of your assets into a fixed equity indexed annuity, and we're going to talk about that in 2 weeks, okay, in more detail, but one without hidden fees, one where there's zero risk of downside. That's the kind of fixed equity indexed annuity that we're talking about here. If you're not thinking about that, or at least understanding that better, you're making a really big mistake. But even if you're a young person and you're thinking, oh, I'm in it for the long haul, if there is a big correction by the time I retire, I'll never even remember it. That's largely true. But why not have a portion of my assets? If I know the stock market is at historically high valuations, why would I keep all my assets in them and not put a meaningful amount of my assets somewhere like this IUL, as we've been discussing, where my downside is zero. When that big correction happens, I'll absorb none of it, but I'm still getting up to 12.75% that I'll never pay taxes on if I'm wrong on the timing and the market keeps going up for another 5, 6, 7 years. I'm getting up to 12.75% tax-free during that time. If then we have an 80% correction, doesn't affect me at all. Okay, I still get 0.75%. That's my minimum. That's what an IUL will do for you. So again, guys, agent commission is based on how much life insurance is in your IUL. Okay, some agents may not even know how to structure an IUL for minimum life insurance and maximum cash. I find that kind of hard to believe, but it's possible. It's not against any regulation for an agent to just structure your IUL in a vanilla way, where about half of the money you put in is paying for the life insurance and the other half is going into your cash. If I don't see, when we structure it correctly, 70% or more of the money you've put in your first year, in your estimated cash, it's estimated cash at the end of year one, estimated because we don't know what the stock market's going to do in that first year of your policy. But whatever, use the estimated cash. If I don't see at least 70% in there, I'll tell you it's underfunded. It's not adequately funded. If I do see that, but I don't see more cash in your plan, then every penny you've put in cumulatively by the end of the 10th year, meaning if you haven't broken into a profit based on your estimated cash by the 10th year, again, I think too much of your money is paying for life insurance, and I'll tell you that. But if you're young and you're healthy and you've got a reasonable budget, and it's different for everybody, by the way, we should be able to hit those metrics, and in fact, probably see you breaking even much sooner than that 10th year. Structure is everything. Okay. And just know this, even though we're minimizing the life insurance on day one, as the cash grows, your death benefit grows with the cash. So when it's structured that way, the cash that you're building up actually gets added to the life insurance. When you pass away, the sum of the two, less any money you've taken out along the way, obviously, remember, take a policy loan, that'll be deducted from the death benefit, but it's the sum of the two, the life insurance and the cash, less any policy loans. That's what's going to go to your family when you die. So the death benefit's going to be rising over time as you build up that cash. So ask yourself a question. If I'm putting in X dollars every month into my IUL, and there are two possibilities. In one scenario, my monthly payment doesn't change in the two scenarios, but there are two possibilities. In one scenario, I pay a much higher commission to the agent and I pay more fees to the insurance company on an ongoing basis for that extra life insurance. And in the other scenario, I pay half the commission, give or take, but a lot less commission to that agent. And I pay much lower fees on an ongoing basis because I have less life insurance. Where do you think the savings is going to go? It's going to go straight into your cash. Okay, that's how it should be done. You've got a truly special product that I don't think is rivaled in the financial services universe if your IUL is structured this way. That's why I'm so enthusiastic about it. So that's a lot of information. But with that, I'd like to open the floor up to any questions. Mitch, do we have anything in the chat?
No, not as of right now. So Jay, when you got into this business, IULs probably weren't the number one priority to you. You probably learned a lot over the years doing this, and the people that we work with, it seems like they're becoming more and more familiar with what IULs can do. How have you seen that change really over the last couple of years, and then specifically the last year, with how that's evolved?
Well, for starters, I spent a decade and a half as a Wall Street securities analyst, and I never heard of an IUL. I would say it's my impression that IULs structured this way, the way financially sophisticated people structure their IUL is exactly the way I just described it. because they had people who knew what they were doing saying, let's set this IUL thing up with minimum life insurance. Let's get 80% of your money going into the cash. Growing with the stock market every year up to double digits, tax free. You take it out, you keep getting the compounded interest from the stock market on the money you just took out and spent, less the interest they charge you, which is a super competitive rate of interest because the loan is 100% secured. Man, that's pretty good stuff. That's what they were doing. And that's why the IRS created a formula to prevent what they considered to be really aggressive allocations into that cash relative to what the plan had for life insurance. So it just wasn't talked about. I never heard of it. And when I finally heard about it and I started to look at it, the more I peeled back the onion, the more I felt like I understood it. And that, again, if it's structured the right way, it's just a great product that everybody should be taking advantage of. More recently, it's all over the internet, right? IULs, it's everywhere. A lot more people have heard about it. Okay, but here's the problem. A lot of agents are advertising it because there's a lot to say to make it attractive to prospective clients. But if the agent isn't explaining this critical piece on minimizing the life insurance to maximize the cash, as I said, there's nothing special about it at all. And it might even be a money pit, a waste of your money. And overwhelmingly, agents aren't doing that because that goes against their own economic interest. And they're not violating any rules, any regulatory rules, by not volunteering that to you. Now, if they bait and switch you by showing you an illustration that has maximum cash and minimum life insurance, and then you say, yeah, let's do it, and in the application itself, they flip that and max out the life insurance. Now, a lot of states and a lot of carriers require that the client and you sign the illustration. So that should come out one way or the other. But this Kyle Busch lawsuit that came out a month or so ago, the NASCAR driver, he alleges, we don't know exactly what his policy looks like, but he alleges that he was told, if you put $2 million a year into this IUL, Kyle, and do that for 5 years, you are guaranteed $800,000 of lifetime income. Now, that's very possible that that's what he could have achieved. But at a minimum, he should have been told that's what you could achieve if the growth of the market is X or whatever. And the only way that could have been achieved is if that IUL was structured the way we're suggesting it should be structured. Minimum life insurance, which would still be millions if he's putting $2 million a year in, and he's a relatively young, healthy guy. It would have had to be structured that way in order to max out the cash that's growing with the stock market every year. So Kyle Busch says in year 6, he gets another invoice. He'd already put in over 10 million bucks. And he got another invoice. And I think he suggested that he was told his policy was going to lapse if he didn't put another 2 million bucks in. The only explanation for that is that agent maximized the life insurance in his plan. And clearly Kyle Busch didn't understand that that's what was going on. And so now he's filing a lawsuit and saying he was misled.
Okay, a couple of questions. If you can answer, I'm not sure if you know this, but what is the difference between IUL and a GUL?
I don't traffic in GUL. I assume that's a guaranteed universal life. And I'm not gonna get into it in much detail because I'm not that close to it. Okay, so I mean, a participating whole life is a completely different product. It also has compounded interest on money that you've spent, but the growth in your cash in a participating whole life is driven by the dividend yield of the carrier, which have been pretty consistent with the A-rated carriers. So in that scenario, you're going to get a minimum growth rate of 3.5%, but your likely growth rate is going to be in that 4.5 to 6% range, but almost zero chance of any upside above that 6% range in any given year. But nothing can ever be changed on you in a participating whole life policy. Okay, so it's got some similarities, but it's more conservative. The IUL, you're growing your cash with the stock market. We don't know what that will do. got a lot of history on what it's done, but we don't know what it will actually do. And that's the risk. Now, if my downside is I just don't get growth in the year when the market goes down, and I structured my IUL with minimum life insurance in it, then I've now significantly reduced that risk of, well, I don't know what the market's going to do in that IUL. A variable universal life is completely different than an IUL. Okay, variable universal life, you can lose a lot of money. Your money's going into the stock market. There's no guarantee against losses. When the market goes down, the cash in your variable universal life goes down with it. We are not talking about that. And in the 1980s, some people lost a lot of money in variable universal life. Different animal.
Jay, a couple other questions. So, what is the cap per year on how much you can add to the cash value?
Okay, so when you apply for your policy, if you structure it for minimum life insurance and max cash, which is everything we just talked about, the way we structure it that way is by setting up the illustration, telling the software, if Brian is putting in $500 a month as a healthy 50-year-old who does not smoke, whatever the profile is, whatever the age, gender, and health profile is, and monthly payment amount, we're going to tell the software, what's the lowest amount of life insurance that Brian can get away with in this plan if he puts that much money in every month without turning his policy into what the IRS would call a modified endowment contract or a MEC. That just means you lost the ability to take money out tax-free. You don't want to do that. So when we structure the illustration, we go right up to that threshold where one more dollar of your money going into the cash rather than into the life insurance would have turned your policy into a MEC, and you would have lost the tax-free benefits. Well, so what does that mean? Let's assume that we structured your illustration that way. You're like, hey, I like this a lot. If I could get this, I'd take it. We apply. You don't pay to apply, by the way, but you have to apply to actually get the offer of coverage from the carrier. Let's assume then the carrier approves you exactly as you've applied. How did we structure it? You can't put one more dollar in this plan without turning it into a modified endowment contract unless you add some additional life insurance. The software figured all that out for us when we structured the illustration. Once the policy is issued by the insurance company, there's a life insurance amount in that policy. And the life insurance carrier is not going to say, hey, Brian, we'll add more life insurance because you want to add more money every month. They won't do that. They want to take a fresh look at your health. They're a life insurance company. So every extra dollar you decide to put in after your policy is issued is going straight into the cash. There's no slight increase in the life insurance to keep you out of the MEC. So if you just increased your monthly payment meaningfully, you did it right away, you'd probably turn your policy into a modified endowment contract. Now, a few years in, you might be able to put a single lump sum, one-time lump sum into your plan, have it all go into the cash without turning it into a MEC. You need to call the carrier or call your agent, have your agent call the carrier on your behalf and say, hey, how much could Brian put in and not turn this into a MEC? So whatever you do today in your IUL, structure the way we've described it, you're not going to have the ability when your cash flow grows 5-6 years to take your size 12 sneaker, the IUL you got today, and turn it into a size 14 sneaker. You might be able to do that lump sum, but what you'd look at that time is doing a second IUL. Your first IUL is going to be structured and set up to be great. You're not going to mess with it. Don't turn it into a MEC. Don't risk turning it into a MEC. There's no risk of doing that if you call your carrier. You just look at doing a second IUL. Well, how much extra money would you have liked to put into your first IUL? That's your budget for looking at a second IUL. If you like what it looks like, you have a second one. Okay,
Does
so
it, I was going to say, does it ever make sense if you kind of know you're going to start making more money to just maybe over insure yourself from the start or not?
I'd say no. Okay, I don't. And I not only do I say no, I emphatically say no. As you might imagine, when you start talking to people and they ask their questions and they get their questions answered, and then we get to the point where we're looking at an illustration, the client needs to provide the budget. Let's look at an illustration based on you putting in X. Yes, the more you put in, the better it's going to look, and the higher the percentage of whatever you're putting in will go into the cash. But affordability, you need to anticipate an unexpected big expense. You don't want to be canceling your IUL 9 months in or 18 months in because you're anticipating making a lot more money next year. And yeah, it was a little bit of an aggressive budget today, but a year from now, this will be really comfortable. No, don't do that. Do what's comfortable today. Do what you can manage today, even if some unexpected big expense comes along. And by the way, every IUL has a contractual option in it, depending on the size of how much you're putting in, your age, etc., to take your monthly payment down to what's called the minimum no lapse premium. And effectively what you're doing is saying, I don't want to put any money into the cash for a while because I had a big expense and the 500 a month is going to be tough for me the next few months. You go to the minimum no lapse premium. Okay, it's typically well below 50% of what you committed to on a monthly basis. And you're guaranteed that your policy is going to remain in force for at least typically a decade or more. You could keep it that low for a decade or more. Now, if you kept it there that long, it'll probably lapse on you. But the point is, you got a lot of runway to reduce those payments, not really be funding your cash until you get your cash flow back where you need it to be, and then you take your number back up again. But no, you do not want to be overfunding it with a stretch number on your budget today on the basis of anticipated extra cash coming in down the road. Do what's comfortable and sustainable today. You're going to have a great plan. You do hit those higher cash flow numbers whenever you expected to hit them, or maybe it took a little longer. Look at doing a second one. You'll have two of them.
Jay, another question.
One more thing. It's not like a
Yeah.
bank loan, guys, or a refi where they hammer you on closing costs. That's not how this works. You look at a fresh illustration. I put an X. This is what it looks like. Sorry, go ahead, Brian.
No, you're good. Just another question. Life insurance versus an IUL. Basically, if we need to pull funds for an emergency, will we be penalized the same as a 401k?
No, the whole point of this IUL is this is your family bank. You're not going to be penalized for anything. It's your money. It is your money, okay? They will lend you up to, depending on the carrier, 80, 90% of whatever's in your cash, you can take out. Now, it's not like an ATM where you get it, real time, but a week, maybe a couple of weeks. There's no like approval process. They're not going to check your credit. They're not going to ask you, what are you going to do with the money? They're not going to hand you an amortization schedule. They already owe you the money. Well, your family, more specifically. When you finally die, they owe you the money already. That's why they're willing to do that. No questions asked. It's your money. So you got money in the cash of your IUL, it's yours. You don't have to pay it back until you die. But unless you're at retirement age, this is just my opinion. You're at retirement age and you're like, okay, we got 180 grand, 500 grand of tax-free cash asset here to supplement our retirement income. Let's start drawing that systematically on a monthly basis. I pull money out, tax-free. I'm still earning stock market growth on the money that I just pulled out. What does that mean? That means my money's going to go longer. That's why it's got a huge advantage over a 401k, where I pay full personal income tax rates on every dollar I take out of my 401k versus zero tax on the cash I take out of my IUL. And the money I take out of my 401k, I spend it, it's gone. I don't keep earning returns on the money that I've spent from my 401k. I hasten to say, every one of us on this call has spent money, a lot of money over the course of our lives, and we've never continued to earn interest on the money that we spent back in the bank account. That's what an IUL does for you. So it's your money, guys. No, there's no penalty. If there's cash in there, it's yours. If I'm retired and I'm pulling the money out, I'm not paying that back until I die. If I'm 45 and I got a big repair on the house or whatever, and I got 30 grand of cash in there, and I take out 20 grand to handle this expense, that I'm going to pay back. I mean, it's up to you, but I'd pay that back on my own schedule, of course, but I'm just replenishing my own personal bank. That's why I'd pay it back.
Jay, I don't know if you touched on this, but living benefits, um, chronic critical terminal illness.
Yeah, so if we start thinking about living benefits, right? If I've got a life insurance policy, what does it do for me while I'm alive? I know what it's going to do for my family when I die, right? So that's what living benefits is referring to. What do I get out of this while I'm still very much alive? Everything I've talked about on this call today, an IUL, minimum life insurance, max cash. That's about maxing out my living benefit. There's no better living benefit than the cash in a whole life policy or in a permanent policy like an IUL. There is a distinction. Okay. Permanent is what an IUL is. The best living benefit is cash. Why? Because I don't have to explain why I want the money. I don't need a doctor's note to get my money. It's my money. So that's all we've talked about so far. Now, if I had a term policy, that has no cash in it. And if I'm still alive at the end of the term, it's gone. I had the coverage while I was alive for a lot of good reasons. I could want to do that. But the policy lapses if I'm still alive at the end of the term. But during the term, the best living benefit I could possibly hope for in a term policy is chronic illness. What does that mean? I need help with any two of the 6 daily tasks of living. You can Google them. The 6 daily tasks of living: bathing myself, dressing myself. Any two of those 6, I'm considered chronically ill. That's the trigger for any long-term care policy. So you start pulling money so you don't wipe out your assets because you need assistance with 2 of those 6 daily tasks of living. Chronic illness means I've got long-term care included. That's considered a great living benefit in a term life policy. That's included in an IUL. It's almost a rounding error when you think about it, because cash is what I'm already maxing out here. But if I did become chronically ill, in addition to the cash that I already have available to me, I could tap into the life insurance component because I'm chronically ill. Critically ill, that's more serious than chronic illness, but it's not as serious as terminal illness. If I got any type of a cancer, below the skin cancer, there's a whole bunch of different things that constitute a critical illness, and some are way more serious than others. So there's no blanket, this is how much you can get if you're critically ill. But if you're critically ill, you could also tap into the life insurance. That's in every IUL. And terminal illness. If your doctor says, hey, get your affairs in order, statistically, you're not going to be here in 2 years. That's considered terminal illness. I can accelerate the life insurance component. My family doesn't have to wait until I die to get the money. Again, you can get all 3 of those in some term policies. They are all included in an IUL. But cash is king. There's no better living benefit than cash.
Jay, a technical question from another advisor. Do you use the Pathfinder tool to do basically a comparison of a generic 401k versus a IUL?
So yes, and it really demonstrates if you've got a young client, it's going to show why an IUL structured, as we've discussed, is better than a 401k. In almost any theoretical scenario of what the stock market might do in the future, unless you come up with something outrageous, like the market goes up 20% every year forever. That tool will show you that the economics of having your cash in the IUL, even with some portion of the money you're putting in going into life insurance, that the economics of the IUL will outpace the economics of a 401k. However, that said, that tool does not give you the ability to assume reinvestment of dividends if I had my money in a 401k, which in theory, I could be getting dividends and reinvesting them in my 401k. Okay, dividends are a huge piece of the returns of the stock market. So that's the only little thing to be mindful of on that tool for whoever asked that question. It's a wonderful tool. As I showed you in this presentation, straight investment in the S&P 500 versus happens to be Transamerica's IUL getting up to 12.75%, maximum 12.75. I showed you that the cash in Transamerica's IUL since 2000 has significantly outpaced a straight investment in the S&P 500, but that didn't include dividends. So then I explained to you in this presentation, let's assume dividends were reinvested. How does that change it? The cash in the IUL still beat it in that 25-year period. It was much closer, but it still beat it. I don't expect that to happen over the long haul. And I wouldn't want to tell somebody I think that's going to happen, but that can happen. What's likely to happen, what I do think is going to happen, if I can have a floor of 0 on my downside, or Transamerica positive 0.75% is my worst case, F&G positive 0.25%. Most IULs, your downside is 0, right? No participation in the losses. If I can take losses off the table and get up to 9.5, 10, 12% of the upside, it's going to be super competitive with just getting into the best asset class, which is the stock market, on a straight up investment. It's going to be very competitive at the end of the day over the long term, except now I have none of that downside volatility. That should be enough. If I explain that clearly and carefully and correctly, and maybe have to explain it a few times just to make sure somebody understands it, they're going to get it. This is a great home for some portion of my spending. This is a really smart thing to do.
Well, Jay, I think that's it for questions. Lee, did you have anything to add?
Yeah. What does it look like when I hear people like Kyle Busch or someone wanting to get a bunch of money in as quickly as possible into an IUL? Is that just they're getting a big life insurance policy and then they're doing what you were talking about, is not paying anything after they get a bunch in there? How does that work? Or is that even a thing? I guess
Yeah, good question. Really good question. So I got a friend who I'd known for a long time, very successful guy, and he's got 2 kids in their 20s, and he wanted to essentially pre-fund a pretty substantial IUL on each of them. He wanted to put 200,000 lump sum, be done with it, right? He liked that better than the idea of putting $5,000 a month in, because if he dies tomorrow, they can't afford to put $5,000 a month in, so they're just going to be forced to cash it out, and that defeated the purpose of the asset. The wealth transfer, the big asset he wanted to create for them. But here's the big point. I told him, you don't want to put a $200,000 lump sum in up front. Remember what I said about the IRS having a formula, and a modified endowment contract is what we want to avoid. Some people say, I don't care about that. I just want to put a ton of money in there. I'm not a buyer of that, but I don't want a MEC. I don't want to lose my tax-free withdrawal benefits. So whatever I'm putting in, the formula basically says, we want to look at how much of that money is going into your cash relative to how much of your money is paying for life insurance. So it's a ratio in a complicated formula. If he put 200,000 in as a lump sum on either of those 2 kids, there'd be $5 million of life insurance on day one, which nobody wanted that. That's a lot of coverage on day one for young, healthy people. It would have required blood and urine because of the life insurance amount. You just don't want it. You wanted to do it to max out the cash. And so I said to him, let me optimize how you're going to put the 200,000 in. And you put this 200,000 in escrow. Okay, so the part of, if you pass away tomorrow, how are they going to fund it? You've already put that money somewhere in your trust, if you have a trust. So he's going to scale in like 35,000 a year. And then the last year, it's like less than 30. It's a stub. But that brought the life insurance in the application to below $1 million. There was no blood and urine required for that. My commission was 1/10 of what it would have been if I just said, yeah, let's do it. Let's put the 200,000 in right up front. And I'm not saying I'm a hero. Let's just do right by the client. This guy happened to be a friend, but do that for everybody you talk to. So that MEC thing is what you've got to, that's your counter to somebody wants to just pre-fund it. You just need to be mindful of that. Okay. A big lump sum up front is almost never going to be the right way to do it. You want to figure out, well, how do we optimize paying that lump sum in as 6 lump sums over the next 6 years, or some combination of lump sums and monthly payments. That's how you want to do that. Again, because you don't want to lose those tax-free withdrawal benefits, and you don't want to front-end load the policy with too much life insurance. Here's another really important part of an IUL, guys, not to get too deep in the weeds, but an IUL is actually, the life insurance component in the IUL is actually a 1-year term policy that automatically renews every year. That doesn't mean the client gets a phone call and has to answer health questions every year. It automatically renews. But by being a year older, they're charging you more for the life insurance. The monthly payment isn't going up, but more of the monthly payment has to be paying for life insurance with every year you get older. So the more life insurance you have up front, imagine being 20 years out and being in your late 60s or early 70s. If you started off with 500 grand of life insurance in there, you're getting charged a lot for that 500,000 in 20 years because you're 20 years older. They keep ratcheting up the cost of the life insurance to reflect your higher age. So if I start my plan off with the minimum amount of life insurance, and then let's say I want the client to stop making payments altogether at age 67, I can also start reducing the life insurance after age 67. The death benefit that goes to my family is not going to come down, even though I'm reducing the life insurance, because the cash value is going to grow by reducing the life insurance. I'm offsetting that higher cost of the life insurance by reducing the amount of the life insurance. And that savings exactly offsets the decline in life insurance by increasing the cash value. So the sum of the two, my death benefit stays flat. So from 67 to 73, the death benefit may not change, but my cash value keeps growing. In the internal guts of the plan, the life insurance is lower. If it's my wife who's collecting the death benefit, she's not going to raise her hand and say, hey, just out of curiosity, how much of this was life insurance and how much of this was the cash? She gets the death benefit. I'm just telling you, it's the sum of the life insurance bucket and the cash bucket, less any policy loans that have been taken out. So that's a little bit deep in the weeds. But again, if you're not told that, you're not going to have your IUL structured in an optimal way.
Well, Jay, I think that pretty much wraps it up. Definitely, again, appreciate you coming and doing this. Your insights are very, very valuable, and just to be able to help people out. Again, I've watched you work firsthand, and the value for what you do for people, and the sincerity for how you do things right by client. I see it every day. So, again, appreciate you coming on and talking a little bit more about the IULs.
Pleasure being here, Mitch. Thank you again.
Yep, thanks.
Good luck to everybody, and don't hesitate to reach out. If your eyes glazed over a little bit on this call, don't worry about it. Schedule a one-on-one with one of us, and we'll walk through it and make sure you really understand every aspect of it. As I said, it's not for everybody. I happen to think it's for most people if it's done the right way. But have a conversation. You got nothing to lose. It doesn't cost